Today we will be discussing the financial analysts of AT&T and Verizon Wireless. Some topics that will be addressed consist of who are our shareholders, the importance of cost of capital, the cost of debt and equity financing between both companies, the effects that financial restructuring may have, and the overall value of the firm. Who are our shareholders? Shareholders are a key factor to companies as they are the ones who invest their money to finance companies they believe will be successful in the future. Comparing both AT&T and Verizon, one can see that both firms share 7 of the same investors from their top 10 holders. Vanguard is number 1 for both firms, having a 5.41% control in AT&T, acquiring over 280 million shares, and a 5.39% control in Verizon, acquiring over 223 million shares as of December 31st of last year. AT&T's other major holders aside from the Vanguard Group is State Street Corporation with a 4.5% control in the firm and Evercore Trust Company with a 4.27% control. Both of these holders acquire more than 220 million shares each. Importance of cost of capital. Cost of capital consists of 2 main components, debt and equity. The most important criteria to keep in mind is to always evaluate the opportunity cost before making any further investing decisions. Cost of capital is derived from 6 important factors as listed above. If all these factors happen to become an indication of a rise in business risk, even a single dollar of debt may cause a huge monetary barrier for some companies. Considerations to be taken into account. How does management decide how much debt and equity financing should a company be using? Listed above are some disadvantages and advantages that need to be considered. Short-term needs. Debt financing will allow companies to acquire new assets at a lower cost. The drawback, however, is that loans will need to be paid back with interest. Ownership. Businesses will be controlled with no outside interference, and debt will not dilute ownership interest. Tax deductions. Loans are identified as expenses, which in turn becomes an income tax deduction. Default. Business assets may be at a potential risk if loan payments are defaulted. Limited equity financing. Debt creates higher risk for investors, leading to a limitation on acquiring equity. Debt to equity. This slide demonstrates Verizon's debt to equity in comparison to AT&T. As you can see, Verizon accumulated a much higher debt ratio versus that of AT&T, with the ratio of 8.28 to 0.9502 respectively. The reason behind Verizon's higher ratio is due to its 45% acquisition of Vodafone, resulting in a $60 billion debt investment. This decision increased leverage but lowered its cost of capital to 7.86%. On the other hand, AT&T seems to be borrowing less aggressively to finance their growth in the industry and has been recently rated 5th in the debt-to-equity category amongst its competitors. Cost of debt financing. The cost of debt financing is calculated by multiplying the cost of debt before tax by 1 minus the tax rate. Using AT&T's current cost of debt of 2.5% and the average tax rate of 22.77%, its after-tax cost of debt resulted being 1.93%. Using Verizon's current cost of debt of 5.23% and the average tax rate of 34.42%, its after-tax cost of debt resulted being 3.43%. What this means is that Verizon encounters a higher risk of being able to pay off its existing outstanding debt balance versus its competitor AT&T. Cost of equity financing. On the left, you will see Verizon's 5-year monthly return in comparison to its 2-year weekly return on the right. From the 5-year analysis, Verizon generated excess return over what it was initially expecting. The 2-year analysis conclusion was that the company was operating with less risk and more stability than it was before. From the regression tables, Verizon performed 0.67% better on a monthly basis and 8.04% better on a yearly basis compared to expectation on the 5-year regression. In the 2-year regression, Verizon's beta declined by almost half, due to the following reasons: recovery after the recession of 2008, weaker competition from rival businesses, and its growth of the company. An analysis was made for AT&T's 5-year monthly return versus its 2-year weekly return. As did Verizon, AT&T performed better on a monthly basis than it was expected. On the 2-year weekly analysis, AT&T was performing with a bit more higher risk compared to its 5-year analysis. In the 2-year regression, AT&T's beta increased to 0.73 compared to 0.37 in the 5-year regression. Some potential reasons for greater risk was more competitors in its industry sector and poor economic issues in our economy affecting the stock market. Bottom-up approach. The bottom-up approach estimates significantly higher beta than the regression approach. Considering the beta of 0.4, risk premium of 6.5%, and risk-free rate of 3%, Verizon's cost of equity is 5.6%. This means that Verizon will need to generate at least 5.6% in order to break even and create value for its investors. For AT&T, we calculated its cost of equity of 3.47% by considering the beta of 0.3, risk premium of 5.4%, and risk-free rate of 1.96%. This means that investors expect to receive a return of 3.47% average per year over their long-term positions on their investments to compensate for the risk they embark by investing in AT&T. Overall cost of capital. To obtain Verizon's weighted average cost of capital, we use the capital asset pricing model by including beta of 0.9, risk premium of 6%, and risk-free rate of 4.25%. Its overall cost of capital resulted in being approximately 5.82%. AT&T's overall cost of capital resulted being 2.99%. Based on the weighted average calculations from above, AT&T pays approximately 2.99% on every dollar that it finances. In other words, for every dollar that AT&T spends on an investment, they must make about 3 cents plus their investment costs in order for the investment to be beneficial to their company.
Optimal capital structure is the best debt-to-equity ratio that maximizes value of a company. Debt financing leads to the lowest cost of capital structure due to tax deductibility, but higher debt generally increases risk. The proportion of debt and equity provides insight into how risky the company is for potential investors. Currently, Verizon's structure consists 65% of equity and 35% of debt. The greater proportion of equity shows that Verizon's structure is more sensitive to the cost of equity. By changing its capital structure, the company will achieve increase in leverage that will cause decline in cost of capital, despite the higher cost of debt. So the company indeed can change its capital structure and reduce cost by substituting equity for debt. The greater proportion of debt will eliminate marginal cost and thus reduce weighted average cost of capital. But the company should not rush to acquire on more debt, as it will not really create much of a change to the cost of capital. AT&T capital structure consists 55% of equity and 45% of debt. Due to the less risk AT&T takes with its debt, the required return needed to compensate the debt is sufficiently less than the required return needed to compensate equity. Therefore, by replacing some of the more expensive equity that AT&T acquires with debt, its cheaper source, it will achieve the goal of optimal capitalization. However, one thing to keep in mind when replacing equity with debt is that issuing more debt leads to having more interest paid out of profits. Today, Verizon's value is estimated to be $204.97 billion. Verizon could increase its value by raising even more debt. However, the additional debt should be less than the current cost of equity. If the company decides to raise the debt amount substantially, its increase in value will not be significant. So in our opinion, the best choice for Verizon would be to raise its debt at the lower 4.5% rate, which by approximation will lead to $10 billion growth in value. From the analysis of the previous question, AT&T can well increase its value as a whole by replacing its equity with debt to lower costs. With a market cap of $182.71 billion and its debt of $74.79 billion, AT&T has no current financial threat to default on covering its debt expenses. Verizon is already considered one of the biggest company debtors in the US. As of February 2015, its total debt reached $113 billion, and its rating has dropped to BBB due to its high portions of borrowing. Without a doubt, the company can generate great benefits from the acquired borrowings. Nonetheless, mounting loads of debt always create a risk for a business. With its current debt, the company is still quite stable and secure, but it will not be that secure if it takes on more debt. The company can raise its debt but to optimal level, to the level at which it will be able to manage high debt risks. Last quarter, AT&T had a total debt-to-equity ratio of 0.94. This low ratio signals a more financially stable business. More debt will create some level of risk for AT&T, but it definitely will not be threatening for the company's financial position. On this slide, you can see some key ratio values of Verizon, AT&T, and their competitors. Verizon has sufficiently higher total debt relative to its competitors. Its percentage of current assets to total assets is relatively equal to T-Mobile, but relatively higher in comparison with Sprint. Verizon has a lower percentage of current liabilities, higher long-term liabilities percentage, and higher shareholders' equity percentage. Verizon has relatively higher total debt to equity, indicating that it uses bigger portions of debt to finance its assets. This is not surprising, taking into consideration that Verizon substantially raised its amount of debt during the last couple years. Verizon has also substantially higher profit margin, which means that the company has a better control over its cost compared to its main competitors in the same industry. In addition, Verizon has a higher operating margin, which means it is able to more successfully to pay for its fixed costs. Moreover, the company has high return on asset ratio, which shows that Verizon uses more efficiently the invested money. AT&T has a more stable control of its debt in comparison to its competitors. AT&T also has an attractive level of investment quality for its return on equity, indicating its profitability within its company. Another obvious advantage of AT&T is its earnings per share. None of its competitors come close to its earnings per share. This indicator portrays the more highly added value of AT&T shares to future investors. Both operating and profit margins are somewhat lower compared to Verizon, but AT&T maintains a steady control over its costs. The first method we use to value the stocks of Verizon and AT&T is determining intrinsic value, which is the actual value of asset that is based on underlying perception of its true value. Intrinsic value is calculated by summing the discounting future income generated by the asset. As of December 2014, Verizon's projected intrinsic value is calculated to be $82.93 based on normalized discounted cash flow and book value model. Comparing the market value with intrinsic value, it is easy to notice that the stock is 70% undervalued. Using same model, we found out that AT&T stock has been undervalued by $52.48. Dividend discount model is a method to value stock based on discounting projected dividends. Using the dividend discount model, we notice that Verizon stock is undervalued, whereas AT&T stock is somewhat fairly priced. On this slide, you can see how the same dividend discount model was applied to AT&T. Constant growth stock pricing method is simple but highly useful in valuing stocks. This model is leveraging a discounted cash flow approach that takes into consideration both dividends and capital gains. Using this model, we were able to identify that both Verizon and AT&T stocks are slightly undervalued. P/E ratio was among some other methods that we used to value stocks. Lower PE ratio is more attractive to investors, but it is important to remember that the ratio is often misleading and does not provide all necessary information to make wise investment decisions. The above chart shows PE ratio of Verizon during the last 10 years, and as you can see throughout this time, the ratio tended to change drastically. This kind of abnormality should be examined by investors before making any decisions. Over the last 10 years, AT&T also experienced major fluctuations. You can see it in the chart above. We compared P ratios with earnings per share growth of two companies, and as a result of this method, we came to the conclusion that both companies are undervalued. The final valuation method that used is PEG ratio, which is a metric that determines trade-off between price of a stock, earnings generated, and company's expected growth. After performing the analysis, we found out that both Verizon and AT&T PEG ratios indicate that their stocks are undervalued. When it comes to attracting investors, both companies offer quite secure and profitable investment opportunities. However, after conducting research and performing analysis, our team came to the conclusion that one of them outperforms and is a better investment choice for an investor's portfolio. We decided to choose AT&T as a winner of its comparative research. AT&T has consistently reported higher revenues than Verizon, and we see a bigger growth potential for that company. Moreover, AT&T was estimated to be a less riskier investment. AT&T has higher earnings per share and outperforms Verizon in many other ratios. AT&T is less volatile to changes in market, and its stock seems to be more fairly priced. Overall, according to our analysis, AT&T stands in a better position than Verizon.